let's dive right in because I think we've got a lot to cover. Let's start with the bigger story, and that would be with Stamps.com. Shares of Stamps.com, and that's ticker symbol STMP for our listeners out there, dropped as much as 58%, Dan. On news late last week, wiping out nearly $2 billion in market cap. Dan, for such a steady Eddie company like Stamps.com, which for our listeners has been the leading provider of postage solutions for regular Joes like you and I, and also business customers, what in the world happened when shares can drop 58%?
Well, basically, they are no longer going to be able to sell stamps. And we've thrown around a lot of jokes about this. You know, this would be like if Flowers.com was just in the gym business. But essentially, they're losing their exclusive deal with the U.S. Postal Service. This didn't happen from the Postal Service side. Stamps.com decided it couldn't afford to only be with one dwindling player. And while it had other solutions, its deal with the USPS was very restrictive in what it was allowed to do with other players. So they went to the Postal Service and they said, how about a non-exclusive deal? Can we do things different ways? And they weren't able to make a deal. So they were in the midst of a business pivot anyway. This isn't some like shocking, like, hey, you're renewing our deal? No, oh no. Like they knew this was coming, but it happened a little bit harsher than they expected, and maybe with a little more finality than expected. And boy, did shares tumble.
Yeah, 58%. And so basically, non-exclusive partners sounds a lot to me like a reality show at this point, where they are friends, but will not be seeing each other exclusively. Dan, it sounds like this was not necessarily precipitated by any one thing or even by bad, like, quarterly performance. Am I right?
Their quarterly numbers were good. I mean, so because of this change, they cut their guidance in half. And the problem with it is, when you cut your guidance that much, it's clearly a guess, not a guidance. They are entirely, maybe not entirely, but they are largely changing their business model. They used to focus on selling postage, which was getting you or I or companies to buy postage, buy their shipping software, and most of that volume moved through the U.S. Postal Service. Now they're moving to focus on companies that do shipping and offering whatever the best solution is for that market. So you might be working with, 300 national companies that all work in, the 5 or 6 major ones, but then companies that just do very limited things in very limited areas or very specific carriers for certain types of products. So they're going to try to match you with the best service. They are not alone in this space. Shopify would be a big example of a platform that does some of that. So everything going forward for this company is uncertain. But the reality is they could have kept their deal with the Postal Service, and that would have been ignoring that the Postal Service is a decaying business that probably has to raise prices, that's not financially solid. And when you see Amazon pulling away from these people and taking on shipping customers on its own, you can't just let that go. And just so you can say, yeah, my numbers will be this next quarter, if you know that 3 years from now, your numbers will be terrible if you stick with that business model.
Exactly. And speaking of numbers, just to give our listeners a quick rundown, Q4 revenue was actually up 29% for this company. Full year was up 24%. And when you start digging into some of the actual platform metrics, there was really a lot to like about this company. This was a stock that was a full favorite for a lot of reasons, one of which was their churn rate. So looking at the last quarter, their churn rate, which basically is a percentage of subscribers who discontinue their subscriptions, declined to 2.9%. A good sign. This is an important metric when you're looking at any company with some sort of subscription-based model. And just for context, since 2010, churn rates have actually been on the decline. In 2010, it was actually 3.9%. So what this has been telling us is that more customers have been sticking with their subscriptions, which has been good for them. Additionally, a couple of other metrics that everybody has been liking. If you look back since 2013, compound annual growth rate for new customers has been 10%. Average revenue per user, this is another important platform metric, has grown by 19% over that same time frame. So this was actually one of those situations that on the surface look really good. Because
let me jump in there. So when you talk about the average revenue per user, which over a lifetime has gone up 29%, That is the only piece of news long term, because they've been working for the past year to get a different type of customer, to get a corporate customer that's doing shipping. And that customer is working at higher volume. They are going to be a higher revenue producing company. So if you want to look at anything from this report, because honestly, the metrics of last year don't make sense anymore because they're largely not going to be in that business, or at least not on an exclusive basis with the best terms. So it's not going to be the revenue driver it was. The fact that they've been able to use their shipping platform and get those sort of mid-level companies suggests that this is a well-run business that has a chance of turning this corner as it really moves into an entirely different business model.